Chapter 3 focuses on a concept called job costing. Job costing just refers to tracking all of the production or service costs that you incurred to service a particular customer. When we think of product costs, there are three main categories: direct materials, direct labor, and overhead. If you notice, the overhead did not have the word direct in front of it. That's an important detail to which I will address in a moment. Direct materials represent all of the tangible components that physically compose a product. For example, if you are making a desk, then the direct materials could be the wood, the bolts, the screws, the varnish, anything that would become part of that product we would consider direct materials. They have a variable behavior. One more desk incurs one more increment of materials. Direct labor, this represents all of the amount of employee wages and or salaries that were incurred to make those desks. In other words, the employees have to have a hands-on the product here. It's also variable in behavior. One more desk incurs one more increment of labor costs. These two are quite simple. Overhead represents all other costs other than direct materials and direct labor. I realize that's not a very good definition, but that's exactly what it represents. These tend to be indirect costs, not direct. Now, direct means you can see the physical flow going into the product itself, one-to-one relationship. Overhead, on the other hand, does not have that basic flow into the product. For example, if I am making these desks and I'm using pieces of equipment to help me cut this wood, those pieces of equipment are going to use electricity. And electricity is a cost that's necessary, so it needs to be counted. But I can't see the electricity directly flowing into the product, although I know it's being incurred by those pieces of equipment. Or think of it this way, the actual facilities in which you're located, the employee needs lights in order to see how to use those equipment. And of course that's more electricity. There are other things that are involved here as well, such as insurance. Since you're using these pieces of equipment, if someone gets injured, you would like to be covered. We also need to make sure that the facility is safe and secure. So this is going to entail a couple of additional types of labor. I need a janitor, custodial individuals to clean the facility so that clutter is not there and accidents don't happen by someone tripping or a fire starting by rubbish lying around. I need a security guard, making sure that people off the street are not coming into the plant getting injured, or people inside the plant are not engaging in nefarious activities or fights. So in other words, we want to keep it safe. And so these custodians and the security guard represent what we call indirect labor. It is a labor cost that was necessary, but those two do not have a hands-on touch of the product. The piece of equipment is going to have to be serviced occasionally, so the maintenance man that may come in, he's another indirect labor. A supervisor who is going around making sure that the employees are on task and helping to answer questions and just basically overseeing and managing would also be another example of indirect labor. The president's salary, or the administrative assistant, the secretary, the receptionist, these are not considered overhead because those labor items are not necessary to make the product. They are costs of labor incurred just to run the business, but not make the desks. Those would not be considered a product cost, but as a period cost or non-manufacturing cost. Overhead also considers those supplies that the cleaning custodial agents may be using. So we have those as materials, but since they don't become part of the product, we call them indirect materials. The oil and grease that the maintenance guy, or a part that the maintenance guy may put on, like a belt, those would be considered indirect materials. But there's another form of indirect materials that actually does become part of the product. For example, a label underneath the desk that just identifies the company, or maybe there's some requirement by law that is on there for like fire prevention, whatever the case. That label is inconsequential in magnitude when considering the cost of all the other materials. And so we don't want to track it as a direct material. We just call it indirect material and justify treating it as overhead on the basis of its insignificance. Now, when we deal with overhead, they do not all function the same way. Some can be variable, some can be fixed, some can be mixed. And that is completely contrary to the direct materials and direct labor. They're variable in nature. Overhead is just a mixed bag of all kinds of behaviors. And they're not incurred at the same time either. Some are at the first of the month, such as rent, if you don't own the plant. Some are due at the end of the period, which could be, say, a property tax if you did own it. And that could be not monthly, but annually. Your insurance is typically due at the beginning of your coverage, and you may sign an annual, 6 months, quarterly, or pay month to month. So the time period is big question there. And I could keep going on down the list of all of these overhead items, but they don't behave the same way, and they're not incurred at the same point in time, and that is a very big problem for us. We're trying to come up with an overall product cost so that I can use to establish a pricing structure. But if you don't know all the costs, what am I going to tell a customer? You're going to have to come back December 31st when I know all the costs and then can quote you a price? Well, no, that's ridiculous, because you know the customer would leave and go elsewhere. So what I must do is estimate those overhead costs. And we do this through a process called an overhead application rate, otherwise known as a predetermined overhead rate. And I'm going to find that by taking an estimate of your overhead cost. Now, I can predict this to some degree. Maybe we're going to use a high-low method or a regression using historical data to come up with a predictor. But basically, we're going to look at prior experience and determine how much overhead costs we incurred. And that should be relatively true for the upcoming year, especially if production is going to be about the same and you don't expect cost changes. But if you expect some, you can tweak that and get pretty close. And then you're going to divide it by some estimated overhead activity base. Now, you need to make sure that whatever basis you use has good causality with how the overhead costs are being attributed to the product or service. For example, if I'm a highly labor-driven operation, then I need to use a labor basis for my overhead. So use labor hours, use direct labor dollars, just some labor measure. If I'm going to be highly automated and more mechanical, then probably machine hours, machine dollars, kilowatt hours, something in that capacity that would match how the overhead costs are being incurred by the product or service. But I would never pick an overhead rate such as number of sunny days. That has no relationship to the product, because you're going to be making the product regardless of if it's sunny, cloudy, raining, snowing, what have you outside. So we want to try and pick a basis that's very good with causality. In other words, this driver really needs to match. Since this is an estimate, I know that an estimate opens the door for error. We try and minimize that error, but it's inevitable unless just by pure luck alone you actually predict it correctly. there's going to be a difference, and we call this a variance. And you could be either over or under applied, and we'll talk a little bit more about that when we start looking at our examples out of the chapter. But what I want to talk about, especially from a manufacturer, is how all these costs are tracked. And we do this through a series of inventory accounts. Raw materials, which represents obviously the materials used in production. Work in process, this represents within the processing plant, the shop floor, the production line. These are things that you are constructing that just have not yet been completed. And this could also work for a service organization. The work in process could be, say, for a dentist. When you're getting a tooth filled, you're work in process. If you're getting a crown, you could be work in process all week long because, well, if you've ever had a crown, you know that a mold has to be made of your tooth, and then you've got to wait a few days before a lab can create your new tooth to put in place. And so you're work in process until this is finished. And then lastly, we have finished goods. Now, for a manufacturer, this would be like our warehouse or our inventory for sale. Within a service organization, we typically don't think of finished goods, but say I'm an accountant and I'm doing tax returns and I get one finished and the client is out of town for a few days, and so I'm going to hold that and it's finished goods. It can't be sold to anybody else, but it is a finished good nonetheless. So how does all this stuff look graphically? I'm going to use a tool in accounting called a T account. It's just a way of tracking inputs and outputs. So I'm going to set one up for each of those three inventories: materials, work in process, and finished goods. And I want you to think of everything on the left side of this T account as an input, and anything on the right as an output that is leaving it. So when it comes to materials, you could have a beginning inventory of some on hand that you had left over from last period. But you know that's not going to be adequate to get everything finished, so you're going to go and acquire some more, so you'll purchase some. And together, that's how much materials you could use. Now, you will requisition some of these and send them over to work in process. And once you consider these as outputs and subtract it from what you had available, it would leave you with an ending balance that you could carry over into next period. And this would just repeat over and over. Over in work in process, you could also have a beginning inventory, like the desk example I was giving you. We may not get finished with the desk today, so tomorrow we come in and finish it up. Or you get your tooth crowned. Well, I'm just not finished yet, so I'm work in process. But other things, you're not going to have work in process that carries over. For example, if I'm a restaurant, I'm probably not going to keep a steak on the grill all night and then finish it up tomorrow. That would violate several health codes, not to mention just make it inedible. So some places have beginning inventory and some don't. But you would add the materials that you requisition, you would add some labor, and you're going to put your overhead here. Now I need to talk a little bit more about the overhead. Using a T account for it as well. And as the actual overhead costs are incurred, whether it's some indirect labor, indirect materials, maybe it's the electricity, the rent, the insurance, what have you, I'm going to incur them and call them inputs. So I'm going to track them on the left as actual costs. And I'm going to take out of this my output, which we call applied overhead, which is our best estimate to what it's going to cost. And of course, at the end of the year, unless you just got real lucky, there's going to be a difference here. If you still have money left in the overhead, then you're underapplied. You didn't put enough. But if you have taken out too much, you're going to have an overapplied balance, and you're going to have to fix that. So we'll talk about that, and again, as we do examples. Well, at some point in time, you're going to finish up what you're working on, and you're going to send it over to the finished goods, and we call this cost of goods manufactured. And when you take that out of work in process, if there's anything left on hand, you'd still have an ending balance to carry over tomorrow to finish up, like again the desks. The finished goods, you could have some already in the warehouse, ready for sale. You're going to add more to it. So this is the total amount you could sell. You will sell some at some point, so you'll have a final output, cost of goods sold, and that's a big expense, which is reported on my income statement to help me determine profit. And we saw that already back in Chapter 2 when we were looking at our contribution margin income statements. And then what you don't sell is still going to be here in ending inventory. So this is the basic flow of job costing. I do want to make one small note about these indirect materials. Recall, they are overhead costs. Some companies keep all materials in one account, both direct and indirect. And if this is indeed the case, then when you make a requisition, you need to be careful that only the direct materials are counted in work in process. The indirect one should be transferred down here to the overhead. If you don't do that and just put all materials over here, well, you're going to double count the indirect materials as you estimate your overhead again. We want to avoid that. So if you have indirect materials in the inventory account, just remember that they need to be an input to overhead and not an input to work in process. Of course, the easiest solution is to have more than one material account. One for direct materials and one for indirect materials, and then you'll avoid any potential complications by double counting. So what we need to do is come up with a way to report all of this inventory, the cost of goods manufactured, and ultimately the cost of goods sold. So if you noticed, that work in process account consisted of some additions and some subtractions. So our report needs to look like this format to show all of the inputs and the outputs. And I'm not going to read all the additional items here. You can read through those notes that I have available to you. But let's take a look at these examples out of Chapter 2. We're going to start, Chapter 3. We're going to start with Exercise 2. Exercise 2 says we use a predetermined overhead rate of $23.40 per direct labor hour. Notice the basis, labor hour, so it must be a labor-driven operation. And it was based on a cost formula that estimated $257,400 over 11,000 direct labor hours. So if you take that estimated cost by the basis, it's $23.40. So I just proved that, which was given to you in the text. So we're really being asked how much overhead during the period had been applied if you use 10,800. So during the entire year, month, quarter, whatever this period of time is, as each labor hour was incurred, I'm going to attribute $23.40 to production. So I'm doing this constantly throughout the time. Now the problem gives the impression that now that you know all of the 10,800, multiply it by your rate, and then you know how much your applied is, and then do the final comparison to your to your actual overhead to know if you're over or under applied. And students in the passives question, well, why did we even do this if you know the actual now? And that's true, but note, we did not just wait until the end of the period to do 10,800. We've been doing this on a continual basis. Today we may have used 50 hours of labor between 4 employees or 5 employees, however many. And over the course of the month we may have used 2,000, and we would have been attributing it all along, and in total at the end of the year we've done 10,008. You have to realize all these exercises and problems in the textbook are not going to ask you to do it for 365 days of the year. They're just going to ask you to do the calculation once just to illustrate the impact. So please don't get that and confused. Now when I look at the final comparison here, we've estimated 252, but the actual was 249. So we put too much in there. Now, is this good or bad? Well, I'm going to find out. I'm going to take that variance, which we're over applied, and I'm going to express it as a percentage of the actual overhead costs. This comes up to be about 1.5%. that is exceptionally a well-functioning overhead rate. Now, if this had come up to be, say, 15%, not 1.5%, then I would say the overhead rate's not functioning very well and I need to do something about it. Go revise my estimated costs or come up with a better activity-based value or just a better activity-based period. But this is doing pretty good. Now, the cost here of over, or even if it were underapplied, we have to deal with it. When everything is said and done, you can only account for the actual amounts, not the estimate. The estimate is just a means to an end. It helps you throughout the year, and at the end of the year, the end of the quarter, end of the period, you do have to deal with the actual cost. So there are two schools of thoughts of how you get rid of this variance here. The first school of thought basically says, if you notice, all of these costs, whether it's materials, labor, or overhead, eventually flow through cost of goods manufactured and eventually leave the system as an output of cost of goods sold. So any variance, whether you're under or over applied, just adjust your cost of goods sold. And that works pretty good. But if you have a significant variance, that's going to put a big amount of an adjusted expense on your income statement and could skew your profits significantly. So the second school of thought said that overhead affected work in process, it affected finished goods via cost of goods manufactured, and it does affect your cost of goods sold, which is on your income statement. Instead of just putting all of that variance to the income statement, allocate a portion back to work in process, back to finished goods and cost of goods manufactured, and cost of goods sold. In other words, go back and fix the values to what they should have been if you'd known the actual amounts all along. Now, it takes a little more effort, but this is good accounting, and my personal opinion is you should be doing this regardless of whether or not that variance is significant or not. But there are those who justify doing that all to cost of goods sold on the basis of simplicity, and it's not really going to matter. After all, will a $1,000 variance make a difference to a $10 million operation? That would be no. So exercise 16 wanted us to deal with these two schools of thought. Exercise 16 gives us some T accounts, and we're not going to do all of it here. The problem actually wanted some more work than what is necessary for us. But basically it says in part 2, assume that the company closes any balance in the overhead to cost of goods sold. Make a journal entry. Alright, so if I look at the overhead account, the inputs are 460 and the output was 390, so I know I'm underapplied by 70,000, the difference. Now the textbook says give the journal entry, and I have done this, but we're not going to focus on journal entries in here. Instead, what you should say is I need to increase cost of goods sold by $70,000. Increase it. And that's exactly what this journal entry does. It puts more into the cost of goods sold. Using the second school of thought, which was the allocation, I'm going to take those balances in work in process, finished goods, and cost of goods sold. They're provided to you in the exercise in the table in the textbook. And I'm just going to total those values. Now, these are the overheads that are in each of these areas. In other words, these are the estimated amounts of overhead, and I need to go back and fix them. So in total, there's 390,000, and you can see that's what we've estimated. So that means 5% is still in work in process. Take the 19.5 and divide by 390,000. 15% is in finished goods. 58.5 divided by 390,000, and 80% is over here in cost of goods sold. So what I'm going to do with that $70,000 is I'm going to take 5%, adjust work in process, 15% of the 70 will go to cost of good, will go to finished goods, and 80% of the 70 will go into cost of goods sold. So this would increase work in process by $3,500, increase finished goods by $10,500, and increase cost of goods sold by $56,000. And you can see I'm not putting quite as much in cost of goods sold, so it won't have as significant of an impact. And those are the basic approaches. Exercise 6 is the actual formal report that I just mentioned to you we're going to prepare. And so this is wanting us to do it for Primary Corporation. And exercise 6, part 1 says prepare the cost of goods manufactured. So I'm going to take that beginning work in process, and that's given to me in the exercise as $56,000. I need to add the materials. Now, they were not given to me. All I know is purchases of materials and the raw materials balance. So I'm not told the direct materials, but I know I can calculate that value here by analyzing the materials inventory T account. So I'm going to take the beginning, add the purchases, consider what's left, and that'll give me how much I've requisitioned. So the beginning was 12. We bought 30,000 more, so I have 42,000 available. There are 18,000 materials left on hand. We went into the warehouse and counted them. And in this case, it just says raw materials inventory, so I know those indirect are in this account. So I need to make sure I exclude them to avoid double counting. And only that will yield the direct materials. Now the labor was provided to me, but I could calculate that if necessary. You just look at your payroll records. If everyone is on a wage, well, how many employees, how many hours, what's the pay rate? You can calculate that. And then, of course, the overhead has been applied at $87,000. Now remember, inside this $87,000 are those indirect materials, so I definitely wouldn't want to count it twice. I'll add these three production costs, and they total $164. And when you combine it with what you started on hand, that yields $220,000. We still have 65 left on the production floor. We're not finished. And when you subtract those, we completed $155,000. Now I'm going to use this $155 to calculate the cost of goods sold. Remember, cost of goods sold is found over here from the finished goods inventory. So let's analyze the beginning, adjust it by the cost of goods manufactured, compare it to the ending, and well, that's how much we've sold. So the beginning was 35. The cost of goods manufactured up here of 155, well, that's going to be a direct transfer down. And that also gets me to a point that if you make a mistake in determining the cost of goods manufactured, it will cause your cost of goods sold to be in error as well. So I will add that to what I had to begin with. Gives me available. When you subtract what's left on hand, it gives you your cost of goods sold, but this problem wanted us to take any over or underapplied variance and just use that first school of thought and adjust cost of goods sold. So in this case, remember, we were underapplied by 4,000. So let's take that and make it greater. Now how do I know to add? Well, if I'm underapplied, you did not take enough out. So that means that this has been understated and we need to boost that expense. So there's the 152. Alright, so let's stop and think about the merits of this under versus over applied. We can clearly see here that in the case of the under applied, you just had to make your expense greater. If you're trying to make your expense greater, then that's going to be a problem for me. because that means that throughout the entire period you had estimated your product costing less. Now, if you estimate your product costing less and you applied your markup to that, you run the risk of not marking it up enough to cover your costs. So that's not good. Every time someone buys something from you, you're basically just giving it away. Alternatively, if you're over-applied, you've put too much in there, and this wouldn't have been an add 4,000, it would have been a subtract. In other words, we estimated our costs were too great throughout the year, and when we mark it up, well, we basically have priced our product a little more expensive than what it should be. The only risk you're running here is it's too expensive, people won't buy it. But I would prefer that versus selling everything below my cost and paying people to take it from me. So I would rather be over-applied than under-applied. But recall, if you're pretty close within your means in terms of that percentage difference, like in the prior one we looked at was only 1.5, then it should not be too big of a deal. Now, if you're a little bit greater, like 15%, then that's going to matter. So this is the basic function. If I could collapse all of what we've done so far today with the overhead rate, looking at how to dispense with the variance, and then how it gets reported, this is basically the result of all of these T accounts over here, what we've done. And this is how we have to deal with overhead throughout the period. But let's reflect a little bit more about this overhead. Remember, this overhead has a whole bunch of different kinds of costs in there that are not incurred at the same point in time, that don't behave the same way, and it's going to be very difficult to come up with a predetermined overhead rate where we have a basis that's going to yield true causality with that much variability within the cost. So it might be more prudent not to use one overhead rate, but instead look at your work in process, and maybe we can break this up into multiple departments. Work in process department 1, work in process department 2. So for example, back to my desks that we're making. We could break it down into 2 or 3 departments. Department 1 could be cut wood. Well, that's going to be very heavy machine driven. I'm not going to be cutting wood by hand all day. Part 2 could be assembly. Well, that's very labor driven, people putting parts together. And then part 3 could be finishing, which could be putting the varnish on it. And of course that would be a labor driven. So maybe department 1 should be machine hours as an overhead basis, and departments 2 and 3 should be labor based. So the next thing I want to look at is this very fact of, instead of using one rate, let's use department rates. And this is exercise 15. Exercise 15 has a cutting and a finishing department. And you have some basic data about each department's there. You see the estimate of the variable overhead as well as the fixed, and you see the basis. It says that the cutting department uses machine hours and the finishing uses labor. So I need to come up with a predetermined overhead rate for both departments. So the first thing I got to do is come up with the total estimated overhead. So this is kind of like those little cost functions that we developed in Chapter 2 with either high, low, or regression. So take the fix and then add to it the variable cost. And in this case, it was $2 per machine hour in the cutting department, and we think we're going to use 48,000. So this equals 360,000. And when you take that 48,000, it yields 750 a machine hour. And I'll do something similar in the finishing department, but making sure to use labor hours here instead of machine. And I get 16.20 a labor hour. And then we're asked to come up with the cost of job 203. So I'm going to add all the materials, all of the labor in both departments. But when it comes to the overhead, I'm going to track each department separately. So the cutting department used 80 machine hours, and each machine hour is 750. I'm not going to look at any labor hours, just the machine. In the finishing, I need the labor hours, 20, and that's at 16. Again, don't look at anything else other than what that basis is. That means that when you add those together, you would have applied 924, and there's the cost of your product, 1,954. So breaking this down into multiple departments can help you achieve a bit better causality. And if you can get better causality, then those variances, whether it's over or under applied, should get smaller and smaller and smaller, and your pricing decision should get better and better. Now, I did want to show you one example of how we can use this job costing in a service organization, and that was exercise 19. Exercise 19 says that you're an architectural firm, and there's going to be some word changes here because when it comes to a service organization, we don't think of things like direct materials. We use what are called supplies. A direct material implies that every single unit gets the same treatment. So if I do go to a dentist, not everybody's getting a crown. One person can be getting a teeth clean, one could be getting the filling, and one could be getting a crown. So different supplies were used to perform the services, so we don't usually call it direct materials. Now in this case, they called it cost of subcontracted work. We have direct staff, so there's your labor costs, and then there's the overhead that was given. And then the output said 390 was finished. So that would mean that there's an ending work in process of 35,000 here. Now, before I go on any further, I do want to go back and pick up part 1, which talks about what is the overhead rate. Now, the overhead rate said that they applied studio overhead on the basis of direct staff costs. Now, this problem is rather unique because it doesn't give you the estimated overhead, nor does it give you the total estimated direct staff costs. But I know the relationship from when you use one of these rates is going to be maintained when you come up with your calculation of overhead. So if I look at the overhead that was applied here and compare it to the direct staff costs, that relationship of that rate should still be there. And so that comes up to be 160% per direct staff cost. That's the rate. Now, back to part 2. We already know that the ending balance in the work in process is 35. And part 2 says that only one customer is left, and that's Lexington Gardens. So this problem wants you to try and work with the relationships. So I know that Lexington Gardens is $35,000. And the exercise instructions say that this job had been charged with $6,500 of direct staff costs. Now that leaves me with 2 unknowns. But now that we know what the overhead rate is based on, which is direct staff costs, you can take that 160, multiply it by the 6,500, and you get your applied overhead. Now I'm in business because I know this and I know that now. Just one unknown. Well, the cost of subcontracted work is just process of elimination. 35 minus 65 minus 10.4 leaves you 18.1. So these are some examples of how we apply job costing using an overhead rate, department rates, which is just a refinement of overhead, and how this is reported. Cost of goods manufactured, cost of goods sold, and then a final example to see that all of this is equally applicable to a service organization.